It does seem like there's so much optimism. Stars are aligned, especially with Trump saying, you know what, the war is ending, or, we're done with this. We've had him say that about 49 times since the war started. Some say even like 5 times in the last 9 weeks. Why should we care? And do we care?
Not really, because I think that, yes, we care if oil prices were to really go parabolic. But I think that the big story, and that's very clear even from the opening remarks from your team, is that this is all about AI. Right? That's what's really driving markets around the world. If you look at even relative performance, it's all about AI. So just stepping back a bit, that something similar happened last year, which is that we were all obsessed with tariffs on the news front. And yet, tariffs did go up. But people forgot about that story because it was superseded by the AI boom, the amount of capex which is happening as far as AI is concerned. Something similar is going on this year, which is that, yes, oil prices have gone up. They have settled at a much higher plateau, even after the decline over the last day or two. But the AI boom is just so much bigger that it's swamping all other effects. So it's very analogous to what happened with the tariffs, which was a negative, that the average tariff rate in America today is much higher than what it was, even though people talk about Trump having walked back and stuff, which is true. But it was 2.5%, the average tariff rate, before Trump started the escalation on the trade war. And even after he pulled back, we settled at about 10% or so, very significantly higher from where we were. And yet the markets and the economy withstood all of that, mainly because of the AI boom. Same thing is happening this year, that oil prices are higher, but because this AI boom is so powerful, the companies just keep increasing capex. Everyone's convinced that the world is moving towards AI as the future, that's all that markets seem to care about.
Interesting you talk about parabolic, and we have seen parabolic moves before, right? Mm-hmm. Gold, silver, even oil to some extent, a moment in time, but never at this scale. The question really is, how long can this last? I mean, the momentum, the rally can't go on forever.
Yeah.
What are the catalysts you're looking at?
Mm-hmm. So I frame this in 3 ways, really. One, that if you look at history, the last 300 years, every single technological innovation has been accompanied by a financial bubble. Every single, from the railroads to the internet, canals, whatever you look at it, it's all been accompanied always by a financial bubble. Because when you have a great technological breakthrough, it's fantastic for the world. That's what the world progresses on. But it leads to a huge amount of overexcitement. Companies invest, and then they overinvest. And so that's how it goes on. But there are 2 lessons to this. One, that very rarely do these companies which are investing end up making money on their investment, because they typically overinvest. It's the consumer that ends up making money. And the second most important thing is this, and we learned this in 300 years of looking at bubbles, that the consistent factor which pricks the bubble is that when you have higher interest rates, until you have high interest rates or some sort of a liquidity event which tightens money in the marketplace, bubbles don't just burst under their own weight. So I think that's the zone we are currently in, that interest rates are pretty stable across much of the world. I'm watching the 10-year in the US obsessively. It's not, in any sort of a major breakout. It's stuck between 4 and 4.5%. Now, if the 10-year in the US were to get to 5% or more, that's when I think that you'll begin to get people asking questions. What's my return on investment? How much am I going to make out of all this massive capex I'm spending? Until then, this arms race goes on. So yes, this is a bubble. When I look at the, I have 4 criteria to try and map out if we have a bubble or not. It deals with overvaluation, overinvestment, over leverage, and over ownership, the 4 O's that I call them. On most of these 4 O's, this is quite advanced. Now, you can argue that we're not that leveraged. The balance sheet of these companies which are over-investing now, they are still doing it out of the cash flows. The debt they're taking is still relatively small. But apart from that, we are overvalued on most metrics. We are over-owned. I mean, 60% of American households today have exposure to the equity market.
Which is the highest in the world, actually,
among all countries. It's the highest in the world, and in fact, America is the only country where people have more of their wealth in the stock market than even in the property market, which includes their own homes. Typically in China or other places, it's the other way around. People have 5 times more wealth in the property market than in the stock market. So this is a very extended bull market. But having said that, as I said, that as long as interest rates are low, and interest rates, I say, are low because they're about 3.5%, 4%, whatever you take the short interest rates. But nominal GDP growth is much higher. Like it's running at 4 or 5%.
Ruchir, concentration risk. You take a look at Korea, at Taiwan, all the massive rally has been pretty much down to 3 stocks.
Exactly.
I mean, the risk has become structural, no?
Absolutely. I think that this is why looking at indices has become very misleading now, because, like the same few companies are driving the index. So you spoke about the emerging market index. In fact, the emerging market index today is even more concentrated than the US index. Remember, for years we have spoken about how in the US, the S&P 500 is very concentrated, dominated by these big tech companies, almost like never before. In emerging markets, something very similar has happened. So you're getting this massive dislocation take place that for this year, markets like China, India, these are actually down in dollar terms, or like India is still down 10% in dollar terms, and yet these Korea, Taiwan markets, these are up anywhere between 70% for Korea, 40% for Taiwan. On a 1-year basis, they've all doubled or so. So you're getting massive dispersion. So as I said, the world has now become about a monomaniacal focus on AI. Which countries have AI? Which countries don't have AI plays?
India doesn't have AI, and India has been tumbling, and foreign investors, foreign funds have been making an exit. What would change that? Would it take an AI bubble bust for foreign investors to start pouring money into India again?
Yes, I think so. I think that India has been perceived that way, that it's become an anti-AI play, because the current phase of AI we are in is all about infrastructure build out, who's got the compute, who's got the infrastructure to build all of that. And India never invested that much on that front. I mean, India, if you look at the amount they spend on research and development as a share of the economy, it's 0.6% or so. Whereas these Korea, Taiwan type people, they do 4 or 5% of their GDP in R&D. Even China, US is closer to 3%, right? And those are very large economies. So I think that that's been India's so-called fault line. Now, of course, at a later stage, when it moves much more to AI adoption, then maybe India has an opportunity of using AI to try and improve its productivity and its efficiency. But currently, the problem is that countries like India are seen on the wrong side of the AI trade for 2 reasons. One, as you mentioned, that they don't have this kind of semiconductors or compute, which the entire world is chasing just now. And the second, and this may be a bit of a myth, but at least that's the perception, is that a lot of jobs are seen to be at risk because of the AI disruption that India has.
Especially in the software sector.
Software, even the GCC sector. So these kind of sectors, there's a job risk, and there are about 10 to 15 million Indians employed in this, and some of them tend to be well-paying jobs in India, and jobs has been a structural issue in India. So on both those fronts, India is seen as a bit of a risk. Now, at some point in time, valuations will get attractive, and the fact that India, that the nominal GDP is growing at 10% will offer an attractive entry point. But for now, sentiment has become that way. And it's true not just of India, it's true of some of the Southeast Asian countries as well. Like, I was having a look at Philippines the other day. Like, no one even talks about it. But the Philippines market today, on some metrics, is trading at the lowest valuation since the East Asian financial crisis.
Would you buy it then?
Well, I think that, like the way I'm thinking about the portfolio today is this, if I can say so, that you think about how much AI you want in your portfolio, and then what are the cheap hedges that you can have in the portfolio, which is that these are cheap, they will not work just now, but let's say this reverses, that for some reason interest rates go up or the bubble bursts, like what are the things that could benefit? So yeah, I think that in India, Philippines, could be the kind of places, but in general what I find is that the best hedge to this currently is not even gold and all, because what's happened to gold is that gold used to be a good hedge, but because it had such a tearaway rally, it's no longer become a risk-free asset. There's a lot of risk now embedded in that price. So yeah, gold will do okay. But I think that the best quality stocks in the world today are the best hedge to this, because quality as a factor has done quite poorly, particularly like in international markets. And by quality, like I'm good companies with an ROE of more than 15%, some earnings growth, but they have all done poorly because there's been such a focus on just having AI, and many of the AI plays, we speak about the Magnificent Seven, apart from that are in fact unprofitable.
You talk about AI plays. The US, they say, is still the place to be. And yet back in 2024, you called peak US exceptionalism.
Yeah.
That's not the case. We've seen record after record after record, and we'll continue to test that record.
No, so I'd written, back in, as you're saying, like in December of 2024, that US exceptionalism is peaking. And what did I mean by that? What I meant was that America had a 15-year great run of stock market performance, but I was talking about relative. The fact that the American stock market, relative to the rest of the world, was likely to peak. And when I look back at it, that has happened. That even though the American market has continued to climb higher, since December 2024, in fact, when I wrote that piece that you're talking about, I think since then, international markets have outperformed the US. Despite all this money flooding into America, and there's massive amount of money flooding in, the dollar has, in fact, in the margin weakened. It hasn't strengthened against most currencies. Now, there are some currencies like the rupee and the peso, etc., which have clearly weakened against the dollar.
Crumbled.
Crumbled is fine. You can use the word crumbled. But generally, currencies have done okay. So international markets have significantly outperformed the US since December 2024. And that's very interesting, despite the AI boom happening. So now to the counterfactual, that if the AI boom ends for some reason, I think America would be very vulnerable. So the other follow-up piece that I'd written last year, for my FT column, was that America has become now one big bet on AI. And that's why even Trump and is able to get away with so much. A lot of people here in Singapore and other places are befuddled that how does America get away with all these actions that it takes. And my point is because America keeps bailing out Trump or other policies simply because of its pre-existing strengths, and because of the AI boom continuing, that's why the other actions of America are superseded by the AI boom.
You talked earlier about how you're keeping a very close eye on 10-year yields, which you say is not at 5%, but when you take a look at 30-year yields at 5% and expect it possibly to go higher, isn't that sending alarm bells?
Well, I won't say alarm bells, but it's sending like an orange signal. It's telling you that this is what you should be looking at. As I said, 300-year history of bubbles. Higher interest rates is what kills them. So if you get higher interest rates, the entire equation changes. But, this is still broadly, if you look at it, it's been stuck in a range for a while now, right? So in terms of that. But I think that if interest rates go up, that's when it tells you, hey, this boom is coming to an end. Now, you can say that it's already very advanced. I don't want to be around these, like in this bubbly phase. But there's a lot of performance pressure that people are facing just now. Because if you look at even bubbles historically, you get the best returns typically at the end. Even in 99-2000, that a lot of people speak about how Alan Greenspan in 1996 had said this is irrational exuberance, and it took more than 3 years after that for that to really manifest itself. But, from that statement, the NASDAQ went up multiple times. But I think there are a detail which is often overlooked here is that even in October of 1999, from then to the peak, the NASDAQ doubled. So, the end, when it happens, the last phase of this, when there's a scramble going on, the price action tends to be the most parabolic. And that's what we're seeing in some markets, like in Korea and these places. Now all of a sudden these chip stocks, they're going up 10% a day. I'm talking about, and we're talking about really large cap chip stocks here like Samsung, Hynix and Stoll. That's not normal price action. That tells you that this is in that parabolic stage. But as I said, that until interest rates come and undercut this, it's very hard. There's no science to say that it should stop right here. Because these things just tend to carry on with the momentum of their own. There's so much retail speculation going on, not just in US, even in Korea. And then now you have, like pro-cyclical things going on, that American individual investors are now being allowed access to buy Korean equities as well. So it just fuels this further.
Ruchir, I'm just wondering, against the current geopolitical landscape, how are you pricing that into your investment theory? Because if you take a look at what's happened, amid this Iran war, the U.S. has had to move all its weaponry from Asia to the Middle East. And now we're talking about a shortage of weaponry. In fact, the U.S. has told the EU that perhaps, all the transfers of weaponry may have to be delayed. Inventories are really low.
Yeah.
That's a huge risk for the world, isn't it?
Yeah, but markets are very bad at pricing these kind of risks. And that's because of the fact that, in all fairness, because 99% of the time, these risks never materialize. There are always geopolitical risks out there. In the 1%, probably that they materialize, like the First World War or something as grave as that, the markets are blindsided by that. So that's the problem, that, as I said, more than 90% of the time, you have geopolitical risks and they don't quite materialize. And there's a line which I always repeat, that history is better remembered than it's lived. That we now look back and think that this is a very geopolitically fraught time. But at any point in time, geopolitics always seems that way, because there's always some risk there, even in the best of times. People, before I think we were born, in the 1960s, speak about, the fact that there were all sorts of fears that US and Russia would, Soviet Union at that point in time, would have a nuclear war. And you had, all these exercises of people hiding under desks and stuff in, like, America. Similarly, in the best of times of the early 1990s, the peace dividends coming through, there was a real fear, and Margaret Thatcher and all would speak about that the Soviet Union, as a last gasp to stay in power and to stay united, would launch a nuclear attack, to try and assert its authority. So, and that was, remember, now we look back at the 1990s as a golden period about, geopolitical stability. So my point is that geopolitics is always volatile. Yes, it seems it's a bit more volatile now compared to the last 20 to 30 years, but the markets are very clear, which is that usually, they fade geopolitical risk, and in the 1% chance that something really disastrous happens, they're always, shocked by it.
How do you think this will play out for the midterms? I mean, Ken Griffin did say that, the Democrats going to win.
Yeah. Well, if you look, here's the problem with this, right? Which is that, yes, I think that there's an overwhelming consensus that the House will flip. On that, I think that everyone has sort of decided. The Senate is still 50-50, and here's the problem in the polling numbers, that everyone looks at Trump's polling numbers and they're relatively low. But there are two points I'll make here. One, that every American president's polling numbers for the last 50-60 years have been declining. So comparing it to history has become fraught, because in a more polarized world, all numbers are declining. And the second point I'll make here is that if you look at the generic ballot, the Democrats and their polling numbers are in fact lower than Trump's. So, it's about who you're fighting out here. So that's another reason why Trump is able to get away, because a lot of people in America are also very disillusioned with what the Democrat Party is doing.